I mentioned a couple times we're PE backed. We did that in March of 2023, and so coming out of that PE investment process was interesting. We had a very intense process. There's 6 months of content preparation and introduction calls and management meetings and due diligence and negotiations. And as we're coming down the stretch with our selected PE firm, we're starting to look to the future and thinking like, man, there's going to be a press release that goes out that says like we're PE back now, and our PE firm has this treasure chest of relationships that they're going to open up for us, and we need to be ready to capitalize on that. And so we amped up our recruiting and our hiring engines to make sure we had enough supply to fulfill all the demand that we expected. Our biggest fear was telling our new PE partners like, thanks for the introduction, but like we don't have enough people to service them. Sorry. That was not a great way that we thought, to start our relationship. What happened in reality was we were so entrenched in that investment process for 6 months that the executive team collectively took their eye off the business, myself included. Our pipeline had not been properly tended to. Our churn was creeping up. We had some holes that we hadn't paid attention to. And the benefits that we expected to receive from our new partnership, they weren't instantaneous. Like they needed to be planted and grow. And so, what effectively happened was we ramped up all of our supply, and then our revenue stalled out, coming out of that process, which created an issue of our gross margin percentage just leaking month after month, until we got a proper lashing from our our new PE board, which it was a tough conversation, but one that was needed. And the realization that I had coming out of that was monthly reporting was too infrequent for our dynamic business. If you think about the seed of a problem sprouting, if you're waiting until a month-end close and then maybe reporting happening a couple weeks later, you're lucky if you spot your problem in that first set of reporting, right? And so, maybe you don't spot it, and in reality, it doesn't get attention in that first review. Now you're another 4 to 6 weeks out before you're looking at it again. And so we were in a position where we were acting on problems that started 8 to 10 weeks before, and are going to take some time to solve after that. And so 8 to 10 weeks is 20% of the year gone by, and by the time you're solving it, maybe it's 25 or 50% of the year gone by before you're solving problems. And so what that inspired me to do was put in a weekly reporting cadence to our board and our leadership team, with both lagging and leading metrics, with the thought that if we have an opportunity to course correct 12 times or 52 times, that the more frequent assessment is going to create more action within our executive team and our board. And so it's been a game changer in our business. It took some time to get the data structured properly and the tools in place so that it's a 15-minute report. It's not taking an entire day to do weekly reporting, because I didn't want to put that on myself and my team that, hey, an entire day is dedicated to just building reports. Like that's not the best use of our time. And so putting the right structure in place so that we could do it in 15 minutes was key. But now each week we have a view of our monthly P&L projections and our margin projections and bookings and pipeline volumes, sales rep performance, all the key deals that are in front of us. Any new opportunities that have been created in the past week, and any movements in our net revenue retention. And so, when we see metrics start to trend in the wrong direction, we're much quicker to take action. And when we see metrics trending above plan, we can feed that fire really fast. And so, we don't really have surprises anymore. The data's flashed to our board and executive team every week. And what I found and what's been incredibly helpful is no surprises is a key tenet to a successful board relationship. My North Star metric is monthly MRR growth. So our recurring revenue growth. Our model mainly runs on MRR, and so we deploy teams of people and get a subscription charge for that on a monthly basis. And so that's what I'm looking at every day. I know off the top of my head that 3.4% monthly growth compounds to 50% on the year, and so that's sort of like the minimum number that we're looking for is 50% growth year on year. And so every month I'm looking towards how are we tracking towards hitting that 3.4% monthly growth? And then there's a bunch of different layers that come underneath that. And so when you think about monthly recurring revenue growth, there's new logos that come into the equation. There's expanding existing customers. There's existing customer churn, and the net of the expansion and the churn being your net revenue retention. And so there's different layers and different ways that you can skin the cat, depending on seasonality or volume of the business. That sometimes some of those are both bigger in each direction, and sometimes they're a little lighter. But overall, that North Star metric tells me whether we're heading on the way to hitting our goals for the year or not.